As we move deeper into the summer months, many investors are wondering what to expect from the markets, especially with volatility still making headlines. There's an old saying in the financial world: sell in May and go away. It's a strategy based on the idea that the stock market tends to underperform during the summer and that it's better to cash out early and wait until fall to reinvest. But in today's fast moving global markets, does that theory still hold water? I'm now joined by Brendan Caldwell, director of Caldwell Securities Limited, to help us unpack this further. Brendan, thank you for the time today.
Always good to be here, Theresa.
Now, what is this theory of sell in May and go away? Is there data to back up this theory that markets will always sell off in the summer months?
Well, how to begin? My birthday is right in the middle of May, the famous Ides of May. So everything goes downhill from that because I'm a year older. So beyond that, though, yeah, there are some statistics to back up that better or worse performing months, particularly in the U.S. market. So June tends to be a weak month. August and September, even November tends to be a weak month. But July is actually one of the stronger months of the year. And while October has a bad rap because twice in the last century there was a really particularly wicked market crash during October, October is actually not that bad. So it's pretty hard to say to sell in one given month and everything's going to be fine. That you'll you'll miss all the bad stuff in the market and catch all the good stuff if you just invest between, I don't know, December and May and be out of the market between May and November. It's well, it's one way of doing it, but if you got a strategy that works for you, don't knock it.
And are there any recent years where this strategy clearly worked or completely backfired?
Oh well, I think it's backfiring this year because this market's been unseasonably strong. I mean, if you'd sold out entirely during any of the bits of bad news that we've had since the beginning of the year, from January through the inauguration, through the tariffs and the elbows up, through the continuing unpleasantness around the world, the wars and the tragedies going on in different places. If you'd sold through and the concerns about tariffs and trade wars and goodness knows what, if you'd sold at any point during the year when things were bad, you would have missed this rally, which we're deep into July, which, as I said, is one of the better months and continues on. This rally seems to continue on unabated despite the larger, somewhat perceived to be negative issues in the world and even here in North America.
Now, some are calling this old school thinking. What are the dangers of this kind of strategy?
Well, any strategy that's being talked about on a program like the one we're doing right now, everybody knows about. Everybody's talked about it. It's been around for a long time. Now, there may be some systemic seasonal reasons that certain months do better. For example, December tends to be a month, particularly if it's been a down year up until that point. December tends to be a month where you can get a lot of selling toward the end of the year, so-called tax loss selling. So what was bad gets even worse. But that's not always true. If December's, and so what'll happen is everybody, they're losers in December, and then January often have a bit of a rally after a difficult December and a difficult year previous. But you can have a so-called Santa Claus rally where people don't want to be out of the market. At the end of the year, where people, I mean, institutional portfolio managers don't want to be seen to not have participated in the big important stocks. So you may see in a good year people buying into the market, and you will also see people deferring for the exact same reasons they sold in a bad December will defer selling in a good December. So you may see December be quite strong, and consequently January actually has a bit of correction as people. So it really depends on the context. Context is everything. But even the most sophisticated strategies, algorithms only that are computer generated, AI generated, only work for a period, because sooner or later all the other algorithms figure out what the algorithm is doing. And if everybody starts doing a thing, whether everybody is individual investors, individual traders, or whether the everybody are AI generated computer programs, I think you'll see that no strategy works for very long. I think any particular strategy in a world of AI, the time frame for which it'll be functional will become shorter and shorter.
And
If anything, you probably will see a bit of a return to the buy and hold, Warren Buffett, investing for earnings type of strategy where investors take a longer view, because ultimately there is no ability for individuals to out trade with speed or out analyze the computers. So it may be that forgetting the noise and sticking with quality may stand most investors in better stead, rather than trying to trade the market against a computer that is working at the speed of light, or at least electrons.
well, what do you believe investors should do during the summer months?
Mm. I think they should relax, not listen to the news, and do what they should do for the rest of the year as well, which is put a little bit of money aside every month. Now, if you're just starting out, a young investor, 100, 200, 500, $1,000 a month, whatever you slightly can't afford, and we've had this conversation before, because the dollar cost averaging effect, whether the summer is good or bad, if it's bad, great, you're going to end up buying more of the investments along the way. And if it's good, not to worry, you won't have invested all your money, and there'll be more to put away when things come when things correct. But and if you're looking at larger amounts of money, let's say you've come into 100,000 or a million or whatever the number. Well, this market's at an all-time high. Do I get in now or wait for a correction? The thing is, all-time high markets don't tend to correct. The exception that proves the rule is the market was at an all-time high just before the COVID virus hit in March of 2020, and we had a severe correction. But it is the exception that proves the rule, because it was a very event-driven global catastrophe that ended up not being quite as bad as advertised. No matter how bad it wasn't the end of the world as we know it. And the market rebounded with great speed to even higher highs by the end of 2020. So just because the market's at a high isn't a reason not to invest. But I wouldn't invest all of your money, 25%, 30%, 10%, just something. Because for most people, that will make the second decision easier. Market continues to go up, you can say, thank goodness we have some, and they'll make your second investment. If the market corrects and goes down, you can say, no worries, we still got most of our powder dry. So do a little bit of something, whether it's a monthly contribution or whether it is investing just the portion of the money that you've received.
And do you believe that volatility is a buying opportunity, and why?
Oh, yeah. Volatility is like the weather. Everybody talks about it, but nobody does anything about it. Or at least they don't do what they should. At least with the weather, if you hear it's raining, you're going to have an umbrella usually. But with volatility, everybody wants to talk about, oh, this market, this thing. So there's always something to talk about. But volatility is actually an investor's friend, simply because there's always something that's doing well. It could be that company nobody else has heard of, but their product you really like a lot. I think that's a good company worth investing in. There are different types of investments. Funnily enough, stock exchanges themselves, which became public companies in their own right over the last 20 years, do very well during periods of volatility, because the correlation between volume on exchanges and their share price increase is actually quite high. So you have the weird effect that the stock market can be going down, but the company that actually runs that stock market, say NASDAQ, or especially the Chicago Board Option Exchange, the CBOE, because it's one of its most profitable products, is something called the VIX, the Volatility Index, which when volatility is high, people trade an awful lot of the VIX. And because it is a proprietary product of the CBOE makes rather a lot of money doing that. So there are investments that actually benefit from volatility. But whether it's exchanges or a product that particularly well, there is always something to do. And just what I referenced a few minutes ago, dollar cost averaging. If you're not doing everything all at once, putting all your eggs in one basket, putting all your chips on red, or Seabiscuit or whatever, but if you're putting a little bit of money aside every month, you are buying more when it's lower and less when it's higher. Dollar cost averaging is the benefit of volatility for most retail investors.
Well, Brendan, thank you so much for the time today.
Thank you, Teresa.